Well, hello, good evening, and welcome back to Rainbow Investing, where we examine a spectrum of ideas to improve your long-term wealth. Now, tonight we are going to be talking about investing and why it's easier than you think. We're going to be talking about how easy it is to get into investing, how easy it is to pick investments that you can just leave in the bottom drawer, and that are almost guaranteed to make you wealthy eventually. So, the type of investing we're going to discuss tonight is, of course, index funds and index investing. We're going to talk about what index funds are, how exactly they work, and why people absolutely love them. And of course, how easy they are to invest in. And of course, I'll be answering the question, is an index fund right for you? So, just before we get going, I'd like to take a moment to just ask you to subscribe to my channel if you haven't already. We do videos on investing and personal finance, which I think is important for everyone, and I'd love to have you on board with the channel. So yeah, just click that big red button below and then we can get started. Alright guys, so index investing. You might have heard the term index fund before. It's a term that's thrown around quite a lot. But exactly what is an index? So the most popular index in the world is the S&P 500. You've probably heard of that because they quote it on the news all the time. Now how the S&P 500 works, well, it's all in the name, 500. It consists of 500 of the largest companies in the United States, or at least that are listed in the United States. Now these companies are organized into a list based on market capitalization, or how large they are. And based on how large they are each given what's called a weighting. So the larger the company, the larger the weighting. And you'll actually find that the top 5, 10 stocks in the S&P 500 actually make up the majority of the weighting of the S&P 500. So whatever those top 5, 10 companies do will largely dictate how the S&P 500 moves and grows over time. So that's an index, but what about an index fund? Well, as I said before, the index is just a list of companies. But an index fund actually invests in those companies, and it does so based on the weightings we said earlier. So if, say, a company like Amazon has a 3% weighting in the S&P 500, an S&P 500 index fund will hold 3% of its assets in Amazon stock. It will technically hold exposure to those 500 companies in the whole index, but it'll have most of its weighting in the top companies. Now, index funds are actually quite a new phenomenon. The first index fund was started in 1976 by the Vanguard group, headed then by John Bogle, who is sadly no longer with us. Now, those first index funds were all mutual funds, but the most popular index funds we see today are actually exchange-traded funds, or ETFs. So the reason why indexes are always quoted in the news is because they actually represent the entire market. They are the market. So if you hear something like the stock market went up 10% yesterday, what they usually mean is the index went up 10% yesterday. They'll normally tell you if it's the Dow Jones, the S&P 500, the NASDAQ. There are a whole bunch of different indexes out there. But the S&P 500 is definitely the most popular. And it's also the most popular index that index funds track in the whole world, I believe. So when you buy an index fund on the stock market, you're not actually buying individual stocks. Well, you are, but they're contained within the index fund. So you're actually buying units of the index fund, not shares of a stock or shares of a company. And the fund that you own shares of, they're the ones that own the stocks of the companies in the index. So when you buy an index fund, you're kind of once removing yourself from the actual stock market. But that does not decrease the appeal of index funds for investing. So why do I say investing is easier than you think? Well, it's because of the simple nature of an index fund. Because it always holds the largest 500 companies in the US, the index actually changes over time. Because when a company grows larger, its holding, its weighting in the index also increases. So 20 years ago, some of the biggest companies in an S&P 500 index fund would have been companies like ExxonMobil, Microsoft, Chevron, General Electric. But if you look at the S&P 500 today, most of those stocks aren't in the top echelon anymore. They've been replaced by companies like Apple. Well, Microsoft is still there, but then Amazon, Alphabet, Facebook, they're all large components of the S&P 500 that weren't there 20 years ago, or at least in that top range. So when you buy an index fund, it actually automatically gets rid of the companies that are doing badly, whose share price is falling, and increases in the companies whose share price is growing. And this is all done without you having to do anything. And that's why these funds are such good investments, particularly for beginners or people who don't actually like investing but want to put their money to work. This is why index funds are so popular. And that's why I think investing is easier than you think. So to illustrate my point, we're going to look at one particular index fund that has been around since 1976. And that, of course, is the Vanguard S&P 500 fund. That's the ticker symbol VFIAX, or VFIAX. Now, VFIAX has averaged an annual return of 11.24% per year since 1976. That means that the top 500 companies on the US markets have returned an average of 11.24% since 1976. Now think about that. That includes the stock market crash of 1987, the dot-com crash of the early 2000s, the global financial crisis of 2008-2009, and of course the 2020 market crash that we saw back in March. Now, even though some of those stock market crashes saw the stock market lose 50% of its value, it doesn't matter. It doesn't matter. 11.24% per year. That's what this index fund has delivered every year since 1976. That's 44 years of returns for you. Now, as I said, you could have just bought this fund in 1976 and never touched it again, and you would be getting that 11.24% per year up until 2020. That means if you put just $1,000 in this index fund in 1976, you would end up with more than $108,000 today. And that's without putting any extra money in. That's just letting the index do its thing. How easy is that? How easy is that? And that's why these kind of funds are so easy to invest in, and I think are really important for everyone to consider. So we've gone over why people like index funds. They're easy, they're pretty cheap. VFIAX has a management cost of, I believe, of 0.14% per year. That's dirt cheap. And also there's actually no risk of bankruptcy with an ETF. Because it holds 500 different companies, the odds of every single company in the index going bankrupt are almost impossible. Think about it. That would mean Apple went bankrupt, Amazon goes bankrupt, Alphabet, Google goes bankrupt, Facebook goes bankrupt, Johnson & Johnson, Coca-Cola. You get the idea. It's probably not going to happen. And any one company that goes bankrupt gets kicked out of the index very quickly. So what are some potential problems with index funds, and are they right for you? Well, not all investors like index funds, and there's a simple reason why. When you buy an index fund, you're never going to beat the market. That's because you're buying the market. You own every stock in the market, so therefore you can't outperform the market. Now, some investors like to try and beat the market, and so an index fund just isn't for them. They like to pick their own shares and invest in them instead of buying all of them. But many investors don't want to do that, and they just want to invest their money while getting on with their lives doing things that they actually enjoy. And in that case, an index fund is probably the one for you. Now, some other things that people don't like about index funds, one is the volatility. Because an index fund always is trying to mirror the market, it's not trying to beat the market, it will perform as the market does. That means if the market falls 50%, your index fund will fall 50%. But likewise, if the market goes up 20%, your index fund will go up 20%. But it will not try and stop a stock market crash from damaging your wealth, unlike, say, a mutual fund might. That's one disadvantage of an index fund. Another one is they're just boring. Like, you can literally buy this index fund, as I said earlier, and leave it in the bottom drawer for 40 years and not worry about it. Now, that might sound great to some people, but for other people, they actually want to invest. They want to look at what companies are doing. And so an index fund is boring. So, is an index fund right for you? Well, that's a good question. As I said earlier, if you enjoy picking individual stocks, playing the markets, checking the markets every day, finding companies that other people haven't found yet that might make you rich one day, companies like Tesla or Amazon or Alphabet even in their early days, then an index fund might not be for you. But if you just want to put your money to work in something that's better than a bank account, and that isn't hard these days, then I would seriously consider an index fund. They're cheap, they're easy, and they're quite stress-free. You can literally leave it alone. In fact, I would recommend leaving it alone. You don't have to think about it. You can just add money to it as you like, and you'll probably get something close to that long-term return of 11.24%. Although there's nothing guaranteed for the future, of course. But in conclusion, you can also do a hybrid strategy. You can have 20% of your money in an index fund just for a bit of insurance, just that market guaranteed return. And then use the other 80% of your funds to buy companies that you find interesting or you think will go up a lot in the future. There's really no right answer for this. You can use index funds exclusively, you can use them in conjunction with investing in individual shares, or you can use them as a small hedge position in case your stock picking skills aren't as good as you might have thought or might have liked. So anyway guys, that's why I think investing is easier than you think. All it takes is that one share of an index fund, and I'll leave a couple of links in the description below of some popular index funds that you can check out if this strategy seems like it's right for you. Okay guys, thank you so much for watching. If you like this video, please leave a like on it. I really appreciate that. And if you haven't already, please hit that subscribe button as well. And what do you guys think of index funds? Let me know in the comments below. I'd be really interested to see what you guys think, and I'll respond to every comment. Alright guys, that's it. Thank you so much for watching. I really appreciate it. I will be back with some more videos soon, but for now, good night.